But what if someone still needs cash flow and they might need to sell in order to maintain that cash flow?
Absolutely.
What do they do?
Absolutely. So there's definitely things you can do. The first is we don't call it timing the market because we don't like those words. But what we can do is look for what we call mini upturns. So in every big, long down market, we have what we call these cyclical bull markets, which are these time periods where the market just jumps up and then it might go down again and then it jumps up. We want to try to at least wait out to catch those up markets. The best way to do that is to have some cash on the sidelines, sort of like an emergency reserve that we normally recommend you have in good times as well as bad. So if you have a bunch of cash on the sideline, then you can use that cash in the intermediate, in the immediate term, so to wait for those sort of mini up periods and then try to sell at those moments because you're paying active attention for when the markets do that. So that's one of the things you can do to at least minimize the damage of pulling in a down market. The other thing you can do is, especially what we've seen in this past few months, is the market went down quite quickly, which meant a lot of people, if you're normally in a 60% stock portfolio, found themselves with only 55% stocks because the stocks dropped and the bonds didn't drop as much. So we normally would want to rebalance that. Well, what you would do to rebalance is if you need the cash, take from your bonds, right? That will automatically make your stock percentage higher and will prepare you for when the market comes back, you have the right allocation to capture the gains on the way back up. So that's another thing you can do in terms of if you have to pull from the accounts, where to look for. And then the third thing, which is really the last thing we want people to look at, is the CARES Act did pass some options for pulling from retirement accounts. And one of the really great things, particularly for people under 59 and a half, is we normally have a 10% penalty plus taxes. Well, you can now pull up to $100,000 from any retirement account. And you have and there's no penalty. They waive the 10%. And you don't even have to pay taxes if you re-put the money back in within 3 years. So you're sort of giving yourself a loan if you can put it back. If you don't put it back in 3 years, you do owe the taxes. Yeah. There's one other.
Wow, that's great. I didn't know about the 3 years.
Yeah.
You can put it back.
Yeah. The second piece you can also do is on a 401k, if your company has a 401k or 403b plan and they've elected it, and they do have to elect this stuff, then you could also take the normal loans, $50,000 up to 50%. They've raised that to $100,000. So you can now do a normal 401k loan. It's usually a 5-year loan. You pay yourself back. The limits have gone higher.
So, but there's interest on that, correct?
There's interest, but you pay yourself interest. Okay. The interest goes back to you, and you pay it over that 5 years out of payroll deductions, assuming you still are working. Yeah, that's but you should check with your if you're still working with your employer for the provider to see if they've elected that. I've already had one client take advantage of that.